stop what you're doing right now because I need to show you something that most Western investors have absolutely no idea is happening. At this very moment, as you're watching this video, silver is trading at two completely different prices depending on where you are in the world. In Shanghai, silver is changing hands at $86.70 per ounce. In Western markets, that same silver, the same metal, the same chemical element, is trading at $77.42 per ounce. That's a difference of over $9 per ounce. That's a premium of nearly 12%. And if you think that's just a minor discrepancy, if you think that's just noise in the global financial system, you're missing something massive. Because when one of the largest economies on the planet is willing to pay 12% more for physical metal than the price quoted on Western exchanges, that's not an accident. That's not a glitch. That's the market screaming at you that something is fundamentally different about supply and demand in the East versus the West. And what's happening in China right now, the buying, the hoarding, the cultural shift toward precious metals, it's something that could reshape how we think about silver and gold for years to come. In this video, I'm going to walk you through exactly what is driving this East-West price split and why it matters for anyone holding physical metal, what's happening on the ground in China as families rush to buy gold and silver ahead of the Lunar New Year, the cultural forces that make precious metals non-negotiable for hundreds of millions of Chinese families, why silver surged 148% in 2025, and what the current setup tells us about what is coming next, and what this persistent Shanghai premium really signals about the future of physical precious metals markets. Now, before we dive in, if you're new to this channel, I'm Mr. Ag, and I focus on bringing you the real story behind precious metals markets, especially the dynamics that mainstream financial media either ignores or doesn't understand. If you find value in this breakdown, take a second to hit that subscribe button. It helps the channel grow, and it helps this information reach more people who need to see it. All right, let's get into it. Let me start by walking you through the numbers because the numbers tell the story. Right now, Shanghai spot silver is trading at $86.70 per troy ounce. Now, why would anyone pay more? Why would sophisticated Chinese traders, institutions, and refiners pay a premium when they could theoretically buy cheaper metal in the West? The answer is they can't, or more precisely, they can't get enough of it. That premium exists because physical demand in China is outstripping the available supply. People want the metal, they want it now, and they're willing to pay more to get it. That's not speculation. That's not a chart pattern. That's boots on the ground demand expressing itself through price. Quick pause here. I want to know where you're watching from. Drop a comment right now and tell me your location. Are you in the United States, Canada, Europe, Australia, Asia? I want to see how global this community is. And while you're at it, tell me if you've noticed premiums changing at your local coin shop or dealer. Because premiums at the retail level often tell you what's really happening in the physical market before the paper price catches up. All right, let's talk about what's driving this demand in China because it's not just one thing. It's a perfect storm of cultural tradition, economic anxiety, and a growing distrust of alternative investments. Right now, China is in the midst of what can only be described as a gold rush. And I don't use that term lightly. Ahead of the Lunar New Year, which is the most important holiday in Chinese culture, families across the country are buying gold and silver in volumes that are straining supply chains. From migrant workers purchasing gold-plated silver jewelry to send home as gifts, to white-collar professionals in Beijing and Shanghai pouring their bonuses into gold ETFs. Precious metals have become the investment of choice for a nation grappling with uncertainty. Let me give you some context on why this matters. Gift giving is absolutely central to Lunar New Year celebrations. Millions of migrant workers travel back to their home provinces, carrying gifts for family members. Traditionally, those gifts included food, cash in red envelopes, and various household items. But increasingly, those gifts are gold, or silver, or gold-plated silver. Because in an environment where the stock market is volatile, real estate has been falling, and nobody trusts the yuan to hold its value, precious metals represent something tangible, something real, something that will hold value regardless of what happens in financial markets. And the demand is showing up everywhere. In factory hubs like Dongguan, sales of gold-plated silver jewelry have surged. Retailers report that inquiries are up dramatically. Workers who make modest wages are still finding ways to buy precious metals because they understand something that many Western investors have forgotten. Real assets matter. Physical possession matters. When everything else is uncertain, gold and silver are the foundation. Now let me tell you about something that might surprise Western audiences. In Chinese wedding culture, there's a tradition called the three golds. When a couple gets engaged, the groom's family is expected to present the bride with 3 gold items: a ring, a necklace, and a bracelet. This is not optional. This is not a nice to have. In many communities, especially in rural China, failing to provide the 3 golds would be seen as deeply disrespectful, almost shameful. it would reflect poorly on the entire family. And here's where the current environment creates real pressure. At today's prices, those 3 gold items cost at least 50,000 won. That's over 7,000 US dollars. For a working class family, that represents months or even years of savings. One taxi driver I read about is already saving for her 15-year-old son's future wedding. She plans to buy about 5 grams of gold each year so that by the time he's old enough to marry, she'll have enough for the 3 golds. Think about that. She's planning a decade ahead because she knows gold isn't getting cheaper and she knows the cultural expectation isn't going away. This cultural demand creates a floor under precious metals prices in China that simply doesn't exist in the same way in Western markets. In the West, gold and silver are investments. You buy them, you sell them, you trade them. In China, gold is woven into the fabric of social life. It's not just money, it's tradition, it's obligation, it's respect. Now let me talk about the investment side because it's not just cultural demand driving this. Middle-class families in China's major cities have made a strategic decision to increase their precious metals exposure, and they're doing it for reasons that will sound very familiar to anyone watching this channel. Economic uncertainty at home, geopolitical tensions abroad, a real estate market that has been falling for years, a stock market that inspires little confidence, and a currency that everyone suspects is being managed in ways that benefit the state more than individual savers. One Beijing-based translator explained it perfectly. When she heard about worsening situations in Venezuela and the Middle East, she and her friends invested more in gold that same day. Her year-end bonus is going straight into gold exchange-traded funds. That's the mentality. International instability equals buy gold. It's reflexive at this point, and it's not just her. Demand for gold ETFs in China has been so strong that banks have had to tighten their risk management policies. They're requiring investors to pass higher-level risk assessments before purchasing gold-related financial products. They're issuing repeated warnings about potential volatility in precious metals prices. Think about what that means. Demand is so intense that banks are trying to slow it down. They're putting up barriers. They're adding friction. And still, the buying continues. That tells you everything you need to know about how Chinese families view precious metals right now. They're not speculating. They're not trading for quick profits. They're protecting themselves. Let me give you the price context because the numbers are staggering. Now I want to address something that many Western investors don't fully appreciate. The premium that Shanghai pays over Western prices is not new. It fluctuates. Sometimes it's small, sometimes it disappears entirely. But when it's persistent and elevated, that tells you something important. It tells you that physical demand in the East is outpacing the ability of the global supply chain to deliver metal. Here's how this works in simple terms. If metal could flow freely and instantly from Western vaults to Chinese buyers, the prices would equalize. Arbitrage would close the gap. Traders would buy cheap in the West and sell expensive in the East until prices converged, but prices haven't converged. The premium persists. That means there are frictions, there are constraints. There's not enough metal moving east to satisfy demand at Western prices, so Eastern buyers pay more. And every time that premium appears, it creates a vacuum. Metal flows toward the higher price, it gets pulled from Western inventories and shipped east, and once that metal moves to China, it tends to stay there. Chinese buyers are not speculators looking to flip metal for a quick profit. They're accumulators. They're savers. They're families preparing for weddings and parents giving gifts to children and institutions building reserves. That metal goes into strong hands and it doesn't come back easily. Let me ask you a direct question. Do you think the price quoted on a Western exchange reflects the true value of silver? If buyers halfway around the world are willing to pay 12% more? That's not a rhetorical question. I want you to think about it. Because the answer has implications for how you view the current price, how you think about premiums at your local dealer, and how you position yourself for what's coming. Now let's talk about what this means going forward, because that's what really matters. If China continues to absorb physical metal at this pace, the supply available in Western markets shrinks. You can't have infinite paper contracts representing metal that has been shipped overseas and locked into family vaults. At some point, the paper market and the physical market have to reconcile, and history suggests that when they do, the reconciliation is violent. Prices don't adjust slowly. They gap, they spike, they move in ways that make the previous range look quaint. I'm not predicting that happens tomorrow. I'm not predicting a specific date or price. What I'm saying is that the dynamics currently in play, the persistent Eastern premium, the cultural demand that isn't going away, the distrust of fiat currency, the geopolitical uncertainty, all of these create an environment where physical metal becomes more valuable relative to paper claims on metal. And here's the part that should really get your attention. The Chinese government is paying attention too. Authorities in Shenzhen, which is home to China's largest gold trading hub, have tightened oversight after 2 platforms failed amid heightened market volatility. When platforms fail, it usually means they couldn't deliver what they promised. They had more liabilities than assets. They were selling metal they didn't have. And when that happens, in a market as important as Shenzhen, the government steps in. That regulatory attention is a signal. It tells you that the demand is real, the stress on the system is real, and the authorities are worried about what happens if confidence breaks. They're trying to manage the situation. They're trying to prevent panic. But they can't change the fundamental reality that demand exceeds readily available supply. Another question for you. If you're holding physical silver or gold right now, does the Shanghai premium change how you think about your position? Does knowing that buyers in China are paying nearly 12% more make you more or less likely to sell? I'd love to hear your thoughts in the comments. Let me shift gears and talk about the broader investment picture, because silver's 148% gain in 2025 is not the end of the story. It might be the beginning. Here's what many people don't understand about precious metals bull markets. They don't move in straight lines. They have explosive legs, higher, followed by corrections that shake out weak hands. They have consolidation periods that feel boring and frustrating. And then they have breakout moves that make everyone who sold early feel sick. Silver is particularly volatile because it's a smaller market than gold. It's easier for large buyers or sellers to move the price. And it has that dual nature, part precious metal, part industrial commodity, that makes it respond to both monetary factors and economic factors. When both of those factors align, when monetary policy is loose and industrial demand is strong, silver can move in ways that seem impossible until they happen. Right now, we have a Federal Reserve that has been cutting rates, which makes non-yielding assets like silver more attractive. We have persistent inflation that has eroded trust in fiat currency. We have geopolitical tensions that drive safe haven demand. We have industrial demand for silver from solar panels, EVs, electronics, and countless other applications. And we have cultural demand from the world, the second largest economy, that treats precious metals as essential rather than optional. That's a powerful combination. And the Shanghai premium tells you that these forces are real, not theoretical. They're showing up in prices, they're showing up in behavior, they're showing up in the physical flow of metal from west to east. Now let me talk about what I'm watching next, because staying informed is how you stay ahead. First, I'm watching the premium closely. If it expands further, that's a sign of increasing stress on the physical market. If it contracts, that could mean demand is easing or supply is catching up. The premium is a real-time indicator of the physical versus paper dynamic. Second, I'm watching inventory levels in Western vaults. COMEX registered silver inventory. London Vault holdings. These numbers tell you how much metal is actually available for delivery. If inventories keep declining while prices stay elevated and premiums persist, the squeeze thesis becomes more compelling. Third, I'm watching Chinese policy. Will authorities try to cool demand? Will they raise barriers to gold and silver purchases? Or will they accept that citizens want to hold precious metals and allow the trend to continue? Policy changes in China can move markets overnight. Fourth, I'm watching Western central banks, the Federal Reserve in particular. If they continue cutting rates, that's tailwind for precious metals. If they reverse course and tighten again, that creates headwind. The direction of rates matters for everything we're discussing. Fifth, I'm watching retail sentiment. When every taxi driver and hairstylist is talking about gold, that can sometimes mark a short-term top. But in China, we're not at mania levels. We're at cultural normalization levels. Precious metals aren't a speculation there. They're a savings vehicle. That's a different dynamic than Western retail FOMO. Let me tell you a story that encapsulates what's happening. There's a taxi driver in Guangzhou named John Weiwei who's already saving for her 15-year-old son's future marriage. At current prices, the 3 gold items required for a proper engagement cost at least 50,000 yuan. That's a lot of money for a working-class family, so she's buying about 5 grams of gold per year, accumulating slowly, planning ahead. By the time her son is ready to marry, she'll have what she needs. That's not speculation. That's not trading. That's intergenerational planning centered on precious metals, and she's not alone. Millions of Chinese families are thinking the same way. They're looking at an uncertain world and deciding that gold and silver are the foundation of their financial security. They're willing to pay premiums. They're willing to save for years. They're willing to prioritize metals over other purchases. That kind of demand doesn't vanish because prices pull back 10%. It doesn't disappear because some analyst on TV says gold is overbought. It's structural. It's cultural. It's deep. Now here's my challenge to you. If you're watching this video and you're holding precious metals, think about why you're holding them. Is it for short-term gains? Is it for long-term wealth preservation? Is it because you distrust the financial system? Is it because you see the same dynamics I see? Understanding your own motivation helps you make better decisions. If you're a long-term holder, short-term volatility doesn't matter. You're not trying to time the market. You're trying to own real assets in an uncertain world. If you're trading for short-term gains, you need a different approach. You need to respect volatility and manage risk. Most people get in trouble because they mix these two approaches without realizing it. They tell themselves they're long-term holders, but then they panic when prices drop. Or they tell themselves they're traders, but then they hold through drawdowns that a real trader would have cut. Know who you are, know why you're in this market, and let that clarity guide your decisions. Let me talk about the Western perspective for a moment, because I know most of my audience is in North America and Europe. The Shanghai premium can feel abstract if you're buying silver at your local coin shop. You're not paying Shanghai prices. You're paying your dealer's price, which is spot plus whatever premium they charge. But here's the connection. Global metal flows affect everyone. If Chinese demand continues to pull metal east, the available supply in Western markets shrinks. Dealers have less inventory. Premiums at the retail level could rise. The metal you want to buy might not be as available as it was a year ago. I've already heard reports of certain products being harder to source. Popular silver coins and bars that used to be readily available now have longer delivery times or higher premiums. That's not a coincidence. It's the global supply chain responding to demand patterns. So even if you never interact with the Shanghai market directly, it affects you. The price you pay, the availability of product, the premiums your dealer charges, all of these are influenced by the global tug-of-war between supply and demand. And right now, demand is winning. Another engagement question. Have you noticed changes in premiums or availability at your local dealer? I want to hear real reports from real people in the comments. What are you seeing on the ground? What's available? What's not? What are dealers telling you? This kind of information helps the whole community understand what's happening. Let me bring this back to the big picture as we approach the end of this video. We are living through a period of profound monetary and geopolitical change. The post-World War II order is fraying. The dollar's role as the unquestioned global reserve currency is being challenged. Central banks around the world are accumulating gold at rates not seen in decades. These are not small things. These are generational shifts, and they're happening while most Western investors remain focused on stocks, bonds, and real estate. Not that those assets don't have a place in a portfolio, but precious metals offer something different. They offer independence from counterparty risk. They offer protection against currency debasement. They offer a store of value that has survived every economic crisis, every war, every government collapse in human history. The Shanghai premium is just one data point, but it's a meaningful one. It tells you that the largest buyer of physical metal in the world is willing to pay more than the price quoted on Western exchanges. It tells you that paper and physical are diverging. It tells you that the people closest to the physical reality are behaving differently than the traders staring at screens. Pay attention to behavior. Behavior tells you what people really believe, and right now, Chinese behavior is screaming that precious metals are essential. Let me give you some practical thoughts to close this out. If you're already holding physical silver and gold, the Shanghai premium is validation. You own something that major buyers around the world want enough to pay premium prices for. That doesn't mean you should never sell. It means you should understand the context of what you own. If you're thinking about buying, understand that premiums exist for a reason. Physical metal costs more than paper price because physical metal has to be mined, refined, minted, shipped, and stored. The premium reflects real costs and real demand. Don't expect to pay spot price for physical metal. That's not how the market works. If you're watching from the sidelines, uncertain about precious metals, consider what the Shanghai premium tells you about the global market. Consider why Chinese families are prioritizing gold and silver despite already elevated prices. Consider whether those motivations might apply to your own situation. I'm not here to tell you what to do. I'm here to show you what's happening and help you think through the implications. The decisions are yours to make. But I will say this, the people who understand these dynamics early tend to benefit. The people who wait until the mainstream media is running front-page stories about gold and silver tend to buy at the worst possible times. Information is your edge. Understanding is your edge. Being early is your edge. Drop a comment below and tell me what you think. Is the Shanghai premium significant, or is it noise? Are Chinese families onto something, or are they just panic buying? Where do you think silver goes from here? I read the comments, and I want to hear from you. This community is full of smart people with different perspectives. The comments section is where we learn from each other. Make sure you subscribe if you haven't already. Hit that notification bell so you don't miss the next video, because in markets like this, information moves fast and being late can be expensive. This is Mr. Ag. Stay stacking, stay informed, and I'll see you in the next video.